Hey guys, Mark with Think Insurance, and today we're going to talk about how home insurance actually works. I know I did a video a while back that kind of explained the ins and outs and the specific coverages. And actually one of my most popular videos right now is Home Insurance 101. I'll link those videos after this video so you can watch those as well. But we're going to dive in and actually go over what's the point of it? Why does it do what it does? What do you need to have it going, and how the whole system or the whole process works. Before we start the video, a quick shout out to Unseen Haze, who made a comment below and recommended that I try real honey with green tea. I actually have done this before. I usually only do it when I get a cold, so I guess it kind of was my mindset, but I do love the drink. I appreciate that. If you guys have a drink that I should try, definitely put a comment below. One of the things that I'd also like a comment from you guys is, as you guys go through these videos, when you learn something new, put that below and let other people know what to look out for, and also tells me that we're on the right path as far as me explaining things correctly. Essentially, home insurance is no different than car insurance. It's a risk. You're assessing the type of risk and what type of a risk an insurance company, a corporation, a physical want-to-make-money place is going to insure the risk for the possibility of your house not burning down or not having a problem or not having water damage. The whole point of the whole policy is to assess how much risk there is, build what I call a profile, and within that profile you can quickly determine what your rates are. Essentially, your home is one of your largest assets, depending who you talk to, that has a lot of money. I think we can all agree on that. Your home holds some sort of account, or it has some sort of equity in it, so to speak. So if something were to happen and we needed to value or sell the home, we would get X amount of dollars back. At the end of the day, what I hear the most is most people say, well, my house isn't worth that much. What they're really talking about with that is the fact that the appraised value is different than your purchase value, or the replacement cost is different than the actual cash value. If you guys want to learn more about that, I'll actually put a video up here as well where it goes over the very specifics of how they calculate the cost in there. Once your home has been valued, they don't count land because you can't actually insure land. You can insure the liability on land, but not the actual land itself. So that's a completely separate thing. We're just looking at total end of the day. We're assessing the home. That's the first part. What's the value? What's the risk? What's the overall factors that we need to create this profile? So that's the first piece. The second part is they're also evaluating how quickly can a fire station respond to that home. Essentially, it has to do with the fire department, how close they are, how quickly they can get water that's near your house, whether there's a fire hydrant nearby, all of the factors that if your house started on fire right now, how much time would on average it take the fire station to come and put that fire out. These are major factors because what they're doing is they're trying to figure out how much money they're going to pay. Because if half of your house burns down, they know that a $300,000 house, they're going to have to pay $150,000 to $180,000 to rebuild that part of the house. If the whole house burns down, now they're really crapped out because they lost at the end. That's really the first part, and the second part where it's creating that profile, and within that profile, it's those pieces. It's also how well do you maintain your home. So we want to know what the condition of your roof is. We want to know if there's any maintenance issues. Could there be any pipes that are going to burst? Is there any underground pipes that are old? If it's galvanized piping, stuff like that. Very specific details. We want to know what type of materials in your home. What kind of hardwood floors do you got? Is it real pergo? Is it just laminate? Is it carpet? All of those little tiny details. Agents don't get into finite details when they quote these because they're just trying to get a good view on what they're looking for. And if it's a fit, then they dig in and get all those tiny pieces. But they want to know those pieces to build kind of that value so they know what that risk is for the insurance company. Now, if you're going to have a loan on the home, you're going to have P&I insurance. You're essentially insuring the loan against that house. So if that house were to burn down, the insurance company is going to pay the mortgage off first, and then anything that's left over, you're going to get that amount. Now, that won't typically happen in most cases because they usually won't pay anybody. In most cases, let's say it's a $20,000 fix or something like that, they're just going to fix it. They're just going to pay a contractor. You're going to work with them just like you would any place, just like you would with car insurance. You're going to find a mechanic. In this case, you're going to find a home builder, and they're going to fix those problems. If the house is a total loss, they're typically not going to pay that out either unless you have an agreement. There are some policies that allow you to walk away. You still own the land and you have the property, you have the debris just sitting there, but they write you a check for that $350,000 and then you can walk away. If you choose that route, they're going to pay the mortgage first, you'll get what's left, and then you can build whatever type of home you want at the end of the day. Now keep in mind what they're normally going to do, and I would say 85 to 90% of all of the policies out there don't have that option. Most companies just don't offer it. So what they're typically going to do is they're going to rebuild the house. They're not going to pay off any loans. They're not going to pay you anything. They're just going to put the house the way it was. And that's what the point of insurance is. It's to indemnify or make you whole, essentially to put you back where you were in the same position. That doesn't mean glamour and upgrades and all that stuff. Now, if the contractor mixes that in and finds a way to fit that in on their own pay, that's up to them. It's completely separate from what the insurance is going to pay for that. They're not going to do the upgraded countertops when you had laminate countertops. They're just going to deny those things. I'm going to be honest with you, most builders don't go too finite into what you had before. They just pick something that was normalized in this range, so they're not going to dig deep and like, oh, is there little specks in this one? There was in his old one, so we better make sure. They're not going to do that. So they're going to make sure that they get kind of similar quality. So if it's a little bit better than what you had, sometimes the insurance company really doesn't care. They just want to make you whole as quickly as possible, because remember, part of your policy is paying for your living expenses, because if my house burns down today, I have to rent another house, and my insurance is going to pay up to that amount, which typically is around $50,000, that they're going to pay $4,000 a month, $3,000 a month, or whatever that cost is for you to pay someone to come mow the lawn, pay for you to rent another house similar size, pay for any overages in gas if you're driving further away from work. All of those little things. You had to spend a week in a hotel, so they're going to pay for that. They had to pay for going out to eat because you didn't have access to a fridge. All of those things that you don't typically get, a living expense as they call it, is going to be part of that policy. So your insurance really does want to get your house built as quickly as possible. The problem that some people run into is the builder and the insurance companies butt heads on what they're going to actually do. Builder may want this done. They say yes, but then there's some problems, and now they've got to reapprove it. So there are some little stumbling blocks that happen along the way. It's not a perfect process because it's just so many options out there. There's so many materials, so many types, and there's not really a given. That's one of the reasons that most adjusters also have a large cushion. So when they're allowed to give approval, they have a certain amount that they can do, and it's pretty large, but once they overstep that, they have to go out and get approval from an actual inspector or some sort of source. Whoa, that was a lot of stuff. So back up. Let's just bundle that whole ball of stuff I just talked about, and let's just put that in the profile, because that's essentially what the insurance is debating the risk of. I went a little bit into detail on that part of it, so let's break off of that. Let's talk about the next process. They've assessed your risk, they've gotten your premium, they're working with the mortgage company, they've got them listed as the lien holders, you're happy, they're happy. So what's going to happen is long term, they count on you not having claims for 10 years. The average claim is about every 10 years. So their premiums are based on that. If for some reason you file a claim before that 10-year period, they're going to raise the rate. It's not like car insurance. It's not at fault or not at fault. There's no one to blame. It just is what it is. There was a claim, there's going to be an increase because the risk profile went from here to here. And in home insurance, it jumps up pretty high, especially if you have a water claim or a fire. Those are the devastating pieces where they can wipe out the whole house. So at that case, what they're going to do is those rates are going to creep up, typically 15 to 20% or higher. I've seen them go 50%. Well, that's stupid. Why would they charge 50? They don't want you. That's essentially what they're telling you. They're essentially, in a way, the business is saying, sure, if you pay that premium, we'll keep it. Otherwise, we recommend you go somewhere else. Could they just drop you? Absolutely. They could cut your insurance off right then and there on the renewal. But most companies have that risk profile where they're like, okay, this is where we are comfortable. There's these upper pieces where we'll charge an extra premium. If they really love us as a customer, we're going to charge that higher amount. If they stay with us, amazing. If they don't, we're perfectly fine with them going with another company for the next 10 years. Partially where they say business is never personal, it really isn't in this case. There's not a specific company that tailors to one specific person. It's not that my agent, Mark, doesn't love me. He does. It's just the company that he has may not be a good fit for me anymore. And if you're an agent like I've been, you'll have 3, 4, 5, 10, 15, 17 different companies to work with, where when company A isn't a fit, typically 75% of those won't be a fit either. but you're going to have some other companies lined up that the premium can lower down to find you a better fit for those type of policies. Now, if any of you have actually been to my website, you have a link there below. It does ask you to do a quote. Now, keep in mind, if you're interested in home insurance, that's perfectly fine. I don't actually have my link made for that. It's made for auto insurance, and it's only going to ask you like 6 or 7 questions. It's really to start the conversation. It's basically plug in your car, you'll talk to an agent, they'll go through that profile that I just went over, and they'll explain like what your options are. Typically, it's when you're looking for home and auto or renters and auto insurance. I don't really press any other option because in most cases, the companies that I work with aren't best fits for those. But what I would recommend is if you're looking for one of those, pretend that you're not insured and there's going to be a phone number that pops up right there. And call that number. What they're going to do is they're going to link you to another company. By the way, I actually don't get paid for that, just so you know. So I'm not making any money by telling you this. But what that's going to do is it's going to connect you with maybe a Geico, maybe an Allstate. It's kind of like a whole slew of companies that are looking for those higher risk profiles. And those are going to be some good options for you. Now, I know you're probably wondering, like, why would they offer an Allstate profile when you just said Allstate's probably looking for a better customer? Part of that reason being is in their models, they actually have a section for higher risk. You never want one perfect type of business. You don't always want the confident planners. You don't always want the people that have one car. You don't always want the middle type of insurance scores. So you want to have kind of a spread array of companies. And what they do is they organize them so it constantly changes. Geico today may want all the high-risk drivers, where tomorrow they only want perfect driving scores. So just to recap, because we covered a lot, so the way an insurance policy works for home is you have your home, you purchase it, you buy it, whatever the case is, you inherit it, doesn't matter, you've got the home. You need insurance. The point of the insurance is to assess the risk so that if something happens, you don't lose your shirt. The other point of it, to kind of step back into that section that I forgot to mention, was liability. And that's the biggest piece of insurance. Anything that happens in the home, if a friend comes over and trips down the steps, a piece of the step chipped off and they fell down the stairs. So that's the liability that's going to protect you there. If you want more of those specific details, the link up here, that's going to get into the actual home details. That's the part that you want to watch. So you've got the home risk, your profile's been created, they measure the distance to the fire station because that's the protection class as they speak, and then they're going to give you a price. Assuming that you're in the average, which is $1,200 to $1,300 a year, that's usually the national average for the US, you're going to fall right in that category. You hopefully never file a claim because you want to just have the cheapest insurance that you never have to use and you never deal with them. However, if you have ever used your insurance, leave in the comment below. Let us know how much of a difference it made, because even if you have a $30,000 claim, I don't have $30,000 sitting in the bank. So I personally am not going to be a good fit for not having insurance or buying the cheapest thing possible. I hope this was helpful, guys. There is one last piece that I wanted to mention. If you're trying to get those prices lower, if they're causing the rates to be too high and you think that it's just not right, either A, fill out the quote below, or B, what I would recommend is look at your deductible. So you don't want to necessarily lower the coverages or the risks that you want to protect yourself against, but you may want to think of a different deductible that might raise that share of loss. So if you have a loss, you're going to pay this and they're going to pay the rest. So that might be an option for you. I hope this was helpful. Don't forget to like and subscribe. I'm Mark with Think Insurance. I will see you in the next one.